Good morning everyone. Welcome to Oliveboard. I hope you all are fine. So in today's lecture, we are going to watch some MCQs of Module B. We cover all the MCQs of Module B and our Module B is Risk Management. We will see all the MCQs which are related to Macmillan book and also we will learn the concepts behind these MCQs. So let's start today's class. I hope everyone is joining and yes, I am visible and I am perfectly audible. So good morning everyone. We are going to start our today's lecture which is on Module B, that is Risk Management. So basically this is the Module B marathon session. All the Macmillan MCQs are in this lecture, in this session, which are very important for your upcoming examination. So we are going to start in few minutes. Good morning everyone. So in this module, we will cover these units, that is risk and basic risk management framework, which is your unit 11. And then here we will cover our next unit, that is risks in banking business, risk regulations in banking industry, market risk, credit risk, operational risk and integrated risk management. Also liquidity risk management and then Basel III framework on liquidity standards. So yeah, let's get started with our first question, which is on the unit risk and basic risk management framework. Okay. So here is the first question, that is investment in post office time deposit is, when we do investment in post office time deposit, then what type of risk is present there? Okay, so basically for this we know that what is zero risk investment. Zero risk investment is an investment that is basically considered have no risk, as the name is saying, zero risk, that means no risk is considered here. And low risk investment are less likely, we can say, lose value of like suddenly we lost the value, but they also have a lower chance of high growth. That we are usually saying for something we have to take the risk. So in low risk investment there is loss value, there is a value we can lose in a very low amount, but here lower chance of higher growth is also available. Then moderate risk. If we talk about moderate risk, so in this we can say that moderate risk investment, also known as the medium risk and return investments. Second names of here. Now we can say that here it occupies the sweet spot between low risk and high risk options. Okay. Now next is our high risk investment. High risk investment is an investment that has a higher chance of losing money than other types of investments. But in these type of risk investment, there is a higher potential for returns. We can say that there also, if there is a high risk, that means there is also a higher potential for returns. Okay, but when we are investing in post office, there will be zero risk investment because there is no risk available. So we can mark here our option A is correct, that is zero risk investment. Okay, moving forward here to the next question, that is zero risk investment implies. Zero risk investment implies, I told you what is zero risk investment, and the option is given: zero variation in cash flow from investment, investment in zero coupon bonds, investment in corporate bonds, and investment in bank fixed deposits. See, if we talk about this, we can say that what is zero variation in cash flow from investment? This means basically investment will, here we are talking about the option A. In this, investment will provide a predictable and consistent return. Okay, with no risk of loss. This is the defining characteristic, we can say, of a zero risk investment. Now, what is investment in zero coupon bonds? While we are talking about zero coupon bonds, it offers a fixed return, but at a maturity they are not considered zero risk because their market value can fluctuate before maturity. That's why investment in zero coupon bonds are not considered as zero risk investment. Then third option is investment in corporate bonds. Basically, corporate bonds involves the risk of default, meaning here we can say that the issuer may not pay back the principal amount or the interest amount. So they are not a zero risk investment. Then investment in bank fixed deposit. While we can say that bank fixed deposit are generally considered relatively safe, but they are not entirely risk free. So zero risk investment is applied where no risk is available. So here in this situation, we can mark the answer of our A option is correct, that is zero variation in cash flows from investment. Okay. Now third question is here. Which of the following statement is correct? Here the options are given. You have to give the answers. So kindly do comments if you are watching this session. Do your comments that which option is correct here. Which of the following statement is correct? Higher the risk would be risk premium. Higher the risk, lower would be risk premium. Lower the risk, higher would be risk premium, and none of the statement is correct. Which option is correct here? Question third, which option is correct? Yeah, very good. Here the option is correct. Higher the risk, higher would be risk premium. Why? Why this option is correct here? See, basically in this case we can say that what is risk premium? Risk premium is also called as the extra return. Okay, extra return that an investor basically expects to earn for taking an additional risk. Okay, and risk, any type of uncertainty is considered as risk, like loss or negative outcomes in an investment. So whenever the higher the risk, there will be higher risk premium. So here option 3 is correct. Who are giving the answer A is very good, everyone. Very good, Jiva ma'am, Sureen sir, Ramkesh, Meena sir. Very good. Now next, which of the following statement is correct here? Higher the risk, focus on the question, just read the options and then give the answer. Higher the risk in a business, higher would be capital requirement. Then higher the risk in a business, higher would be return expectation. Higher the risk in a business, higher would be capital requirement, and higher here would be return expectation, and none of the statement is correct here. Good. Give your answers, do interaction, and also give your best in the comment sections. So this session will become so interactive. See, what is the meaning of higher capital requirement? Basically, businesses with higher risk, those businesses which are with higher risk typically require more capital to generate or we can use the word here to operate. Okay, this is because, why this is because investors demand a higher return for taking or more risk. Basically, the business needs to have sufficient funds to cover any type of loss. So here we can say that higher the risk in a business, higher would be capital requirement and higher would be return expectation. Okay, so this statement, our option C, is correct. Moving to the next one. Very good, everyone. Which is the most crucial function of risk management? Which is the most crucial function of risk management here? See, if we talk about here controlling is also a function of management. After this is the last step in functions of management, and planning and controlling are interrelated to each other. And this is the ultimate goal of risk management because it involves some steps which reduces the impact of negative events on the organization's ability to achieve its objectives. So here we can say that most crucial function of risk management is controlling the level of risk to an organization's capacity. Controlling the level of risk to an organization's capacity. And we know that what is identification of risk, identifying the risk available in the organization, and also we know what is estimating the cost of risk and measurements of risk. Okay, so here the correct option is option A. Okay, option A is correct. Controlling the level of risk to an organization's capacity. You can see that here the word is mentioned, risk management. When we are talking about the management, we have to manage the risk. That's why here we can choose the option controlling the level of risk to an organization's capacity. Okay. So next question, when compared to return of equity and return on asset, RAROC is a better performance measure because RAROC is the better performance measure. What is RAROC? Can anybody tell me what is the RAROC stands for? RAROC stands for, anybody can tell what is the full form of RAROC here? See, RAROC stands for basically risk adjusted return on capital. On capital, it is basically a risk adjusted measure of the return on investment. And here the correct option is, which option is correct here? Very good Jiva sir, very good. 6C, D option, A option, which option is correct? See, if we talk about here, risk adjusted return on capital, we know that. Now what is ROE? What is return of equity basically, and return on assets? These are the traditional performance measures which focus only on the return. Whatever the return is generated without considering the risk involved. Whatever the risk is involved, they are basically focuses on the return. Okay. And RAROC is a better performance measure because it factors whatever the risk taken by the organization to achieve its return. And this provides basically more comprehensive and accurate assessment of an investment's profitability. So here we can say that according to the option, it taken into account the risk undertaken by the organization to get the returns. Basically, they just focus only on the returns. Whatever the returns are generated, they only focus on the returns. So here our option D is correct, and you can read the other options. Other options are useless because RAROC is a better performance measure because it taken into account the risk undertaken by the organization to get the returns. So here option D is correct. So here we learn three concepts: what is ROE, what is return on asset, and what is RAROC. Okay, sometimes there will be the question on the full form too. So basically you have to learn all the full forms, all the correct full forms of the important terms. Okay, so moving to the next question. Yeah, risk in banking business. This now we are going to start our new unit, that is risks in banking business. Very good everyone who are doing comment. So here our first question is, yeah, capital charge component of pricing accounts for here cost of capital, internal generation of capital, loss provision, and then you have to mark the true. Which statement is true? All the statements are true, or one or two are correct, or two or three are correct, and or statement 3 and 1 are correct. 7th A, very good Jiva ma'am, very good. Do comments. Whatever you feel about the comments, whatever you are feeling about the question, you can do comments. See, here first we learn about what is capital charge component. Capital charge component in pricing refers to the cost of capital. Whatever the cost of capital that a company basically must consider when company setting the prices for its products or the services they rendered. Okay, it is essentially, basically we can say that it is essential the minimum rate of return that the company needs to earn on its investments to satisfy its investors. Okay, so here cost of capital is given. What is the meaning of cost of capital? Basically it is the minimum rate of return that an organization must earn on its investments to satisfy its investors. Internal generation of capital is also refers to those funds that an organization generates from its own operations, such as profits. Okay, and loss provision, this is a provision for potential losses basically that an organization may incur, and it basically helps to ensure that the organization has sufficient funds to cover its losses, to cover basically some unexpected losses. So here capital charge component of pricing accounts for the cost of capital and also for the loss provision. So here, according to this, our statement 3 and statement 1 are correct. That means option 4th is correct here. Okay. Because internal generation of capital basically refers to its own operations. That is profits. Okay. So we can't mark this. We can say here option 1, that is cost of capital, and here loss provision is correct. Why you are marking A? Here the option also cost of capital and here loss provision, both are correct. Very good, everyone. So let's move to the next question. Yeah, so basic numerical on this unit, risk and basic risk management framework. Here daily volatility of a stock is given, that is 0.5%. What is its 10-day volatility? So do comment which answer is correct, then we will see the correct answer here. How can we calculate the 10-day volatility here? Solve it, do your comment, share your thoughts, which option is correct here. 8C, okay, we will see. Very good, Sureen sir. Daily volatility of a stock is 0.5%. What is its 10-day volatility? A very basic question on this unit. I hope everyone can solve it. So do practice, do this question ASAP. And also do comments. If you're liking this session, kindly give like and also do the comments. So let's solve. Basically, if we are going to calculate 10-day volatility, here the formula is for 10-day volatility is equals to daily volatility multiply by root 10. Okay, because we have to find this 10 days 10-day volatility. Now here daily volatility is given, that is 0.5%, and then we have to multiply it by root 10. Okay, now solving it further, we get here it is equals to 1.58%. That means our option 3 is correct here. Okay, so here this plays the basic and important role. So we must know how to find the 10-day volatility. So let's move to the next question. Yeah, risk mitigation results in, what is risk mitigation? And risk mitigation basically results in reduction of downside potential, reduction in profit potential, and which of the following is true here? Is both statements are correct or only one statement is correct? Basically, what is risk mitigation? This concept is introduced to reduce the potential impact of any negative event. Okay, of any negative event. This typically involves actions that reduce the livelihood or severity of risk. Okay, and if we talk about reduction of downside potential, basically by mitigating risk, organizations now can reduce the potential for losses and also negative outcomes they can reduce. So this is the primary goal of risk mitigation. And reduction in profit potential is, we can say that while risk mitigation can sometimes have the unintended consequences, of reducing profit potential, that is not always the case. But here we can say that in many instances, if we talk about the risk mitigation profitability, here reducing the likelihood of costly mistakes of disruption. That means we can say that it is also helpful in reducing the chances of any type of risk. So it is also helps in risk mitigation. So we can say that both statements are correct. That means option 1, that means all the statements are correct here. Very good, Sureen sir, very good. So next question, from 1st of April 2020, RBI has mandated the banks to link their interest rates on retail loans to an external benchmark developed by dash or to RBI's repo rate. So we have to fill this dash, what is dash, and also tell me the full form of FADAI and FIMMDA. Then we will see the answer. What is the full form of FEDAI? What is the full form of FIMMDA? We know that from 1st April 2020, RBI mandated banks to link their interest rate on retail loans to an external benchmark developed by the Financial Benchmark India Private Limited, or to RBI's repo rate. Basically, this move was aimed at increasing the transparency, and also it reduces the interest rates that is charged to borrowers. Okay, and FEDAI stands for Foreign Exchange Dealers Association of India. It is a self-regulatory organization which is established in 1958 to oversee and regulate the foreign exchange market in India. And FIMDA stands for here Federation of India Money Market and Derivatives Association. Basically, it is also a self-regulatory organization that represents the interest of various market, and also whatever the participants are involved in India, including banks, financial institution, and also bank brokers that involved in the money market and derivatives segment. Okay, and here Clearing Corporation of India Limited is a financial market. In short, we can say that is CCIL. Basically, this is an financial market infrastructure that providing the clearing, settlement, and some services for a wide range of financial instruments in India. Okay, so here we can mark option C is correct. Moving to the next unit, that is risk regulations in banking industry. Very good. Deepak sir, very good. Sureen sir, good. Risk regulations in banking industry. This is our third unit in module B. So here, first question is how financial risk is defined as, and also tell me the definition, meaning of financial risk. What is the meaning of financial risk here? We know that what is financial risk. It is a loss of which is related to financial loss or damage. Whatever happened to an organization due to some unavoidable events or the circumstances, that is financial risk, and it arises from various things like market risk, credit risk, liquidity risk, operational risk, and also legal risk. We will discuss about these risks in the upcoming slides. So financial risk is defined as, or also if I told you what is market risk. Market risk is type of a risk that is arises from the fluctuations and fluctuations in market prices. Market prices basically interest rate, we can say exchange rates, and also some commodity prices. If there are any fluctuations in the commodity prices, that type of risk is also considered as market risk. Credit risk is a risk, we can say that like such as a customer, supplier, or their financial obligations. For instance, we can say that here a bank that lends money to a borrower may face credit risk if the borrower is unable to repay the loan. That type of risk is called credit risk. Then liquidity risk, this type of risk that in when an organization is unable to meet its short term financial obligations. Okay, that is our liquidity risk. And operational risk is that type of risk in which financial loss occurs due to some inadequate resources, or we can say that some internal fails. And legal risk, these types of risk are occur if any financial loss is occurring due to some legal issues such as fines, lawsuits, regulatory fines. These types of risk are considered as legal risk. So here, if we talk about financial risk is defined as uncertainties resulting in adverse variation of profitability or outright losses. This is incorrect. Uncertainties that result in outright losses, that is also incorrect. And uncertainties in cash flow, it is not correct. Here the correct answer is variations in net cash flows. If there are variations, there are difference in the net cash flows, then definitely this will lead to financial risk. Okay, understandable to everyone? Very good, Sureen sir and Jiva ma'am. Financial risk, here option D is correct. Okay, now strategic risk. Strategic risk is a type of I already told you about credit risk, liquidity risk. Now here interest rate risk is there. We know that strategic risk is a type of risk basically arises from an organization's overall business strategy or direction. Okay, it is basically the risk of making incorrect strategic decisions that could lead to the financial loss or some type of missed opportunities. So basically related to the strategies, this type of risk is basically related to the wrong strategy. If there is wrong strategy, that type of risk is called strategic risk. And here we can mark strategic risk is not a type of interest rate risk, is not a type of credit risk, is not also a type of liquidity risk, because it is totally related to the wrong strategies, wrong decisions made by the organizations. So here we can mark option D is correct, that is none of these. Okay, now a bank funds its assets from a pool of composite liabilities apart from credit and operational risk it faces. If a bank funds its assets from a pool of composite liabilities, then if we if we not consider credit and operational risk, then what type of risk is there? Basis risk, strategic risk, reputational risk, or compliance risk? And we know that basis risk, what is basis risk? Basis risk is a type of risk which is the difference between spot price of an asset spot price of an asset and the price of a relative derivative contract that will change unexpectedly. And spot price of an asset, we can say that is the current market price at which the asset can be brought or sold. Brought or sold, both conditions are there. So here, if we talk about the correct option in this, of bank funds is assets from a pool of composite liabilities. Apart from credit and operational risk, it may faces basis risk, and we know about the strategic risk. Reputational risk is related to the goodwill of a company, goodwill of an organization, goodwill of any institution which is involved. And compliance risk, we can say that what is compliance risk is, it is a type of financial loss or damage to an organization due to non-compliance with the laws, regulations or some industry standards. That is compliance risk. Okay, so here our option A is correct. Fourteenth, a branch sections here rupees 1 crore loan to a borrower. Which of the following risk the branch is taking? A branch sections rupees 1 crore loan to a borrower. Which of the following risk the branch is taking? Liquidity risk, interest rate risk, market risk, credit risk and operational risk. If a branch sections here, which type of risk is there? See, whenever a branch sections a loan to a borrower, the primary risk that take is also a credit risk, and it is also we can say that liquidity risk, and also here interest rate risk and operational risk. And we know about what is liquidity risk. We already discussed what is interest rate risk, credit risk and operational risk. So whenever a branch sections amount to a borrower, so here we can say that liquidity risk will be there, interest rate risk will be there, credit risk is there and operational risk is there. Except market risk, all are the statements are correct. So we will mark option 4 is correct here. Premature payment of a term loan will result in interest rate risk of type basis risk, yield curve risk, embedded option risk or mismatch risk. Premature payment of a term loan, this means we can say that paying off the loan before its scheduled maturity date. Okay, so we know that what is basis risk, what is the meaning of yield curve risk. Basically this is type of a interest rate risk that arises from the whatever the changes are done in the yield curve. Basically this is the graph that shows the relationship between interest rates and the time to maturity for bonds of different type of maturities. Okay, and embedded option risk is a type of risk. In this we can say that embedded type of risk that arises when a financial instrument contains an embedded option. An embedded option is a right or obligation basically that allows the issuer or the holder of the instrument to take certain actions such as early repayment or also changing the interest rate. And mismatch risk is here. Mismatch risk is here basically a risk in which an organization's assets and the liabilities basically have different maturities or interest rate sensitivities, we can say here. So premature payment of a term loan will result in interest rate risk of type, that is embedded option risk. Yeah, 15th option is correct. C option is correct. And here strategic risk is basically related to the risk, Jiva ma'am. Here strategic risk is a possibility that we can say that company's business decision could lead to failure. If any type of decisions which are lead to failure, which can threaten the company's ability, basically which can threaten the company's ability to achieve its goal, that is that types of risk is called strategic risk. Basically here wrong decisions, if anybody in the organization takes the wrong decision, that type of risk related to the strategic risk. I hope it's clear, Jiva ma'am. Yeah, very good. 15th option is C, embedded option risk. Very good. Then 16th question is here. An entity has a credit sale of 20 crores for the read the question carefully. An entity has a credit sales of 20 crores for the financial year ended 31st March 2021. The profit on the sales is 10%. Now the entity has booked a profit of rupees 2 crore on 31st March 2021 on the credit sales before actually getting the cash from the debitors. From the statement, it can be deducted that the firm is following which type of method in accounting. The term is basically following. We will learn about cash system of accounting. This system basically recognize revenue only when the cash is received. Okay, and whatever the expenses are here, when paid, the cash is paid. Okay, we can say that this system recognizing revenue only when cash is received and expenses only when cash is paid. That type of accounting is called cash system of accounting. And also discounting system of accounting, this is basically not a generally recognized accounting method, not a recognized method of accounting. It refers to the specific techniques which are basically used in the industries or those situations that are not related to the fundamental principle of accounting. Okay, and accrual system of accounting, this type of system basically recognizes in accounting, and it refers to the predicting future financial performance. When the future financial performance is predicted, then this type of accounting is called accrual system of accounting. Sorry, this is related to forecast, but in accrual we can say that accrual is like this type of accounting is when revenue is earned. Here when revenue is basically earned, and in this case when the cash is received and expenses, whatever the expenses are incurred, regardless the cash is paid or not, that is accrual. Basically it is used for the company has recognized the profit or the credit sales, then and the company recognized both the things before receiving any type of cash, that is aligned with the accrual system of accounting. So here we can say that in this accrual system of accounting is followed. Okay, very good. 16C, very good. So new unit here, market risks. We will learn about now market risk. a new unit here. So let's learn about market risk. Here also systemic risk. Can you tell me about systemic risk? What is systemic risk? What is the meaning of systemic risk and which option is correct here? Systemic risk is the risk of failure of bank which is not adhering to regulations. Also failure of two banks simultaneously due to the bankruptcy of one bank, and also where a group of bank fail due to contagion effect and failure of entire banking system. Which option is correct here? See, what is the meaning of systemic risk? First, systemic risk is type of risk which refers to the breakdown of an entire system rather than simply the failure of individual parts. So breakdown of entire system. So what is systemic risk? Read options once more here. Read the options once more. So here we can simply mark failure of entire banking system is systemic risk. Okay. Now, central bank governors of G20 countries participate in the Basel Committee on Banking Supervision. Total number of members are here 10, 11, 12 or 13. Central bank governors of G10 countries participate in the Basel Committee on Banking Supervision. Yeah. Very good, Sureen sir. This is the systemic risk. Very good. See, here the options are given 10, 11. First we know the concept. What is central bank governors here of G20? What is G10? What is Basel Committee? Basically, if we talk about the Basel Committee, according to the BCBS, it is an international organization. And what is the work of this? This works to set the standards for banking supervision and also the regulation of banks at the global level. And Basel Committee comprises 45 members from 28 jurisdictions. Okay, but here if we talk about the group of 10 is made up of 11 industrialized nations. And these nations are including central banks which are from Germany and Sweden, as well as the governments which are related from Belgium, Canada, France, Italy, Japan and the Netherlands, Switzerland, United Kingdom and also the United States. Basically this is settled in the established in the 1926 to lend the money to international monetary funds. So according to me here the option is incorrect. If they are talking about this G10, G10 countries are 11, and if they are talking about the Basel Committee on Banking Supervision, it includes 45 members. So I hope the options are incorrect here, as I am because G10 also include 11 countries, 11 industrialization nations. So let me hold this. According to me, answer will 11. Okay, or yeah, answer will be 11 here. I think it's option B is correct. But we will check this. Answer is 11 because in G10 there are 11 industrialization nations, and in Basel Committee there are 45 members from 28 jurisdictions. We will see this. Okay. You also check about this question. This is like your homework. Also check this and also tell me that I am correct or they are correct, because according to me answer is 11. Okay. Moving to the next question here. Yeah, 1988 Capital Accord framework accounted for credit risk, market risk, operational risk, defined capital component. We know every type of risk here. We discussed all type of risk. What is credit risk, market risk, operational risk, defined component, capital component. So basically 1988 Capital Accord, also known as Basel I, and Basel I was the earliest of the three Basel Accords, and also introduced capital reserve requirements for the banks, which are based on the riskiness of their asset. And if we talk about defined capital component, defined capital component is a specific amount of capital that a financial institution is required to hold a cushion against any potential loss. And basically this requirement is typically mandated by all the regulatory bodies to ensure the stability and solvency of the financial system. So here we can say that 1988 Capital Accord framework is accounted for the credit risk, for the market risk, and also for the defined capital component. Our second option is correct here. Okay. Now back testing is done. Back testing is done to see back testing. What is back testing? Basically back testing is done to compare the model results and whatever the actual performance is there. But it is the process basically which is used for evaluation or to evaluate the historical performance of a trading model or whatever the strategy is used at that time, by applying it to the past data and comparing the stimulated results to the actual outcomes. And backtesting is like a vital technique which is used in financial modeling. Okay, it is used in financial modeling. It is also used for evaluating the historical performance, okay, of a trading strategy, and also it evaluate the model or the system. Okay, so here we can say our option B is correct. Back testing is done to compare model results and actual performance. Okay. Very good, Anik sir, Sureen sir, very good. See, under Basel Second, capital requirement under the accord is, what is the capital requirement here? See, if we talk about Basel II, the capital requirement is determined by the regulatory authority, and these regulatory authority based on the bank's risk profile. Okay. Now this means that the amount of a capital, if a bank needs to hold its not fixed but varies depending on its specific risk. And Basel II is a set of international standards which governing the bank capital adequacy and also the market discipline and the market business practices. So here we can say that under Basel II, capital requirement under the accord is, here the correct option is, the capital that is specified by the regulatory authority is required to be maintained. So option C is correct here. Okay, everything is clear to all? Now capital charge for credit risk requires input for PD, LGD, EAD, M, and under advanced IRB approach, who provides the input for LGD? See, if we talk about this advanced IRB approach, here banks are allowed to use their own internal models. Why they use their internal models? Obviously to calculate the capital requirements, and these capital requirements are calculated for the credit risk. Okay, this basically includes the input for the LGD. LGD is loss given default. Okay, now if we talk about here PD, LGD, EAD and M, these are the four key components which is used in calculating credit risk. Okay, and these are comes under Basel III and Basel II frameworks. Okay, so if we talk about in this approach, who provides the input for LGD? Bank provides the input for loss given default. Okay, they are basically used to determine the capital requirement that bank must hold to cover their potential losses from whatever the loans are there or also other credit exposures are there. So here option A is correct. Now under the standardized approach, the rating assigned by the eligible external rating agencies will largely support the measure of, we know that what is market risk, credit risk, liquidity risk and also the operational risk. We know these four risks. What is the meaning of these risks? See, what is a standardized approach? Basically, under the standardized approach, whatever the ratings are there, these ratings are assigned by the eligible external credit rating agencies, which will largely support the measure of credit risk. Okay, so here we can mark the option B is correct. This is basically under the standardized approach, the rating assigned by the eligible external credit rating agencies will largely support the measure of credit risk, and it is a simpler method. A standardized approach is the simpler method which is used for calculating the capital requirements under the Basel II. Okay, moving to the next question. Under the RBI Basel III norms, the DSIFI bank will be plotted into dash different buckets and would be required to have additional common equity tier 1 capital requirements. If we talk about RBI Basel III norms, okay, here domestically, systematically, important banks, that is SIFI, are categorized into 5 different buckets. Why 5 different buckets? Because they are based on their systemic importance. Okay, now each bucket corresponds to a different level to an additional common equity tier capital requirements. Which is, say, the higher the bucket, the greater the additional capital requirement. And basically this system is designed to ensure that larger, more complex banks hold a sufficient amount of capital to absorb the potential losses and also maintains the financial stability. So here the option A is correct. 5 different buckets. Okay. So now we will talk about our next unit, that is market risk. Here we will learn about market risk. Some question we will see in this. First question is there, an 8-year 8% semi-annual bond has a BVP of rupees 125. The yield on the bond has increased by 5 basis points. What is the profit or loss suffered due to increase in a yield as holder of the bond? So calculate this, find out the answer of this, which option is correct here. 8-year 8% semi-annual bond is given here, and also a BVP is given here of rupees 125. So do this, which is correct. How to calculate this? See, if we are calculating the profit or loss which is due to the increase in yield, we can use here basis point value, and basis point value is here in short BPV. Okay, which basically represents the change, and change in the bonds price for a 1 basis point, that is of 0.01% change in yield, we can say. How can we calculate? See, if we are saying BVP of rupees 125 means that every 1 basis point is increases in yield. Okay, the bond prices decreases by rupees 125. The yield increased by 5 basis points. Okay, the yield increases by 5 basis points. So here the formula of loss is BVP multiply by change in basis points. Okay, so it is equals to 125 multiplied by 5, that is equals to rupees 625. So basically here the bond holder suffer a loss of rupees 625 due to the increase in yield. Okay, so here we can mark option D is correct. I hope it is understandable. Here is the loss of 625. Anik sir, there is a loss. Okay. Okay. Here, one day VAR of a portfolio is rupees 5 lakh with 95% confidence level in the period of 6 months. If 125 working days are there, how many times the loss on the portfolio may exceed rupees 5 lakh? See, this one day, this represents basically the maximum potential loss. Okay, potential loss on a portfolio. Now time period is given of 6 months and also days are given. Now there is 5% chance of exceeding the on any given day. If we are talking about on any given day, we can expect the loss to exceed here rupees 5 lakh. Okay, so 5% of 125 days we can calculate, that is equals to 0.05 multiplied by 125, which is equals to 6.25. Okay, therefore we can expect here the loss to exceed rupees 5 lakh approximately as 6 times in period of 6 months. So here answer is 6 days, which is option C is correct. Okay. Yeah, answer C is correct. Now a bank suffers a loss due to adverse market movement of a security. The security was however held beyond the deficiency period. What is the type of the risk that a bank has suffered? Here adverse market movement is there, so we can say that bank has suffered here operational risk. Why operational? Because the security here was held beyond the deficiency period, which implies that the bank did not follow any type of internal policies or the procedures whatever here regarding the timing and selling the maturity. Okay, and basically this type of failure in adhering to the internal controls, guidelines or the risk management practices is considered as operational risk. And deficiency period, this term is little bit different. This type of period is that period which is a specified time frame during which a financial obligation or any type of liability is replaced or fulfilled through a process that is known as deficiency. So this we can mark here. Option B is correct, that is operational risk. Okay. Now a bank holds a security that is rated as A plus. The rating of the security migrates to A. What is the risk that bank has faced? In this case, which type of risk the bank has faced? We know that what is market risk, what is operational risk, what is market liquidation risk, and what is credit risk. Basically in this case the bank has faced credit risk because credit risk is the risk which is refer the loss which is due to we can say here deterioration of the credit worthiness or default of the party or the issuer of a country. Okay, countries or issuers of any type of security we can say. Okay, in this case if securities rating has migrated from A plus to A, indicating a decline in the credit quality of the issuer, which increases the likelihood of the default or downgrade in the future. Okay, so here we can mark option D is correct, that is credit risk. Okay, now the bond with remaining maturity of 5 years is presently yielding 6%. Its modified duration is 5%. What is the Macaulay's duration? If we talk about the relationship between modified duration and the Macaulay's duration is here MD is equals to MD divided by 1 plus Y. And here it is the modified duration, this is the Macaulay's duration, and this is the yield to maturity. And here in this case that is given, modified duration is given which is 5%. Now it is equals to MD, and here we convert it in, we can write it as yielding as 0.06. so it is equals to, when we solve this, MD is equals to, that is here Macaulay's duration, it is equals to here 5 multiplied by 1 plus 0.06. when we solve it we get here 5.30 years. That means option C is correct. Okay, so here the role of this is very important. Now this is not enough to access market risk at a of a portfolio. Stress taking is desirable because value at risk is not enough to assess market risk of a portfolio. Stress testing is desirable here because we know that why stress testing is used. It is used to evaluate the resilience of a portfolio under extreme or any unusual market conditions. Okay, so unusual market conditions, we can say it helps in assessing risk due to abnormal movement of market parameters. So we can mark this option as correct here. Okay, now conditional value at return is also called expected shortfall. What is expected shortfall? It is like a it measures the average loss that occurs beyond the value at risk threshold, providing a more comprehensive value of tail risk and the losses in extreme market conditions. So conditional value at return is also called as expected shortfall. Now we will talk about credit risk, a new unit here, credit risk. Then after this our two units are left. Okay, we will cover all the MCQs in this. Okay. In which of the following is not a type of credit risk? In which of the following is not a type of credit risk? Default risk, credit spread risk, intrinsic risk, or basis risk? Which of the following is not a type of credit risk? See, we know that what is default risk? Default risk is a risk basically that a borrower or counterparty will unable to meet their financial obligations. Any financial obligations can be there. For example, like they are failing to make scheduled interest or the principal payments of a loan or a bond. Credit spread risk refers to that risk basically that is arises from the changes of the financial instrument. Particularly in this case, we can say the bonds. And intrinsic value is a widely defined term in finance or also in the risk management, which is compared to the concepts like credit risk, market risk, or the operational risk. Okay, and we already know about the basis risk, but in this is related to the credit risk, this is related to the credit risk, this is also related to the credit risk. This is the only one which is not related to the credit risk. So we mark this option as correct here. Okay, we know that basis risk is that risk which is in which the value of a hedge will not move in perfect correlations with the values of the asset being hedged. Now, risk of a portfolio with over exposure in steel sector will be, see, risk of a portfolio with overexposure in steel sector will be here more than systematic risk, because a portfolio that is heavily weighted in the steel sector is likely to be significant affected by the industry's specific risk. Basically, some industry specific risks are fluctuations in commodity prices, whatever the changes are in the regulations, and whatever the changes in the market demand due to the specific steel industry. Okay, and we know that what is the meaning of systematic risk? These are the risks that affects the entire market or a particular segment. So we can mark here option A is correct, more than systematic risk. Okay. Very good, S. Kumar sir. Now, risk that arises due to worsening of credit quality. When the worsening of credit quality is here, which type of risk arises from when the worsening of credit quality? See, here we can say that in this type of case, there will be the credit spread risk. There will be the credit risk spread risk, because this type of risk arises due to the worsening of credit quality, and it is described as credit spread risk. It is directly related to changes, whatever the changes are in other credit instruments when the credit worthiness of the issuer is declined. So here we can say the risk that is arise from the worsening of credit quality is credit spread risk. Okay. In order to develop our capability to actively manage our credit portfolio, one must have in place the following: credit rating model, develop and maintain necessary data on defaults of borrower, rating category wise rating migration. Which of the following is correct? And tell me the meaning of credit rating model. See, if we talk about credit rating model, having a credit rating model, or this is essential for all the uh, assessment, for all the assessment of the credit worthiness. Whatever the credit worthiness, this is help in assessing the credit worthiness of a borrower. And different categories of loans and advances may require tailored models to accurately evaluate the risk. If we talk about the developing and maintaining necessary data, so this is a critical for understanding that how borrowers credit quality changes over the time. Okay, basically to actively managing a credit portfolio effectively, both A or B are robust credit rating model and a detailed data on a rating migrations are necessary. So here both statements are correct. Okay. Next question is the model, which is basically combines 5 financial ratios using reported accounting information and equity values to produce an objective measures of borrower's financial health is. That model we have to tell that combines the 5 financial ratios. And we know that Altman's G for score, Z score is a formula which is basically developed by the Edward Altman in the 1960s, in which they predict the probability of a company going bankrupt, if a company going bankrupt within 2 years. That is the formula used to find out this. And also if we talk about the credit metric, this is the model which is basically developed by the JP Morgan. This is developed by the JP Morgan, and it basically focuses on the measuring of credit risk of a portfolio of loans and bonds. And credit risk plus is is basically, we can say that is a credit risk modeling approach. It is an approach which basically ensures or estimates the distribution of potential credit losses in a portfolio. So we can say that here the correct answer is option A, Altman's Z score, because it combines 5 financial ratios and also reported accounting information and equity values, which produce an effective measure of borrower's financial health. Okay. Now tell me about the transaction where financial securities are issued against the cash flow which is generated from the pool of assets. That is securitization, credit default swaps, credit linked notes, and total return swaps. We know that securitization is the process of pooling various type of financial assets like mortgages, car loans, credit card debt, and also it's converting them into the securities. that can be sold for investors. Okay, and here these are investors, and we can say that CDS, that is credit default swaps, are the financial derivatives that are provide protection against the default of any type of default is there in the borrower. And the total return swaps, are basically we can say that one party exchanges the total return from an asset for a specified rate of return. And here credit linked notes, we can say that are linked to the credit risk of a specific borrowers or a pool of borrowers. Basically here the securitization is that transaction where financial securities are issued against the cash flows which are generated from the pool of assets. So our first option is correct here. Now here the RBI norms in case of residential mortgages backed securities. Here as per the RBI norms regarding residential mortgage backed securities, the originator of the securitization transaction should be 5% of the book value of the whatever the loans being securitized as the RBI norms applied here. So no, we can say that no, nothing is changeable in this. This is fixed, that is of 5%, because this type of requirement basically is designed to ensure that the originators have a continued interest in the performance of the loans they are securitizing. So here option B is correct, 5%. Keep in mind in case of residential mortgage backed securities, there will be the 5%. Okay. So everyone who are watching are able to understand the things, the marathon, enjoying the session or not? Kindly do comment, any comment, thumbs up, okay, hi, kuch bhi anything you want. That session is good, you can do, because I think there are 10 or 15 questions are also left. I think 10 questions are left in this. We covered all the MCQs in this. So yeah, please try to interact, try to do comment. Thank you so much, S. Kumar sir. Next unit, operational risk and integrated risk management. Okay. In this, some easy questions are there because no numericals in this one. We can say that. Thank you, Anik sir. See, operational risk arises from the inadequate or failed internal processes, people and systems, external events, defaults, market price fluctuation. Which of the following is true? I think these are the options are given are in very easy language. We can understand what is operational risk. We know that. So which option is correct here? See, operational risk arises always from the external events. Basically we can say that some natural disasters are there, terrorisms are there, and also other events are there outside the organization, which are outside the organization's control. So here we can say that if any internal process is failed, that can be the type of operational risk. If there any type of people and systems is failed, then this type of thing is also called operational risk. If any external events are there, they are also operational risk. But defaults and market price fluctuations are not the cup of tea for operational risk. So here we can mark A, B, C is correct, which means our option third is correct. Okay. Now, international convergence of capital measurement and capital standards recommended for operational risk, that is cause based classification, effect based classification, event based classification. International convergence of capital measurement and capital standards, basically these are referred as referred as to the Basel Accords, and they are recommended the event based classification for operational risk. And this type of classification basically focuses on the categorizing operational risk events which are based on specific incidents or occurrences that can lead to the financial loss. If we talk about event based classification, this approach basically categorizes operational risk, and those operational risks which are based on actual events, okay, that occur within organization. For example, actual events can be we can say frauds, or we can say some system failures. Okay, now if we talk about in this the correct option is event based classification, because international convergence of capital measurement and capital standards recommended for operational risk, that is event based classification. Option C is correct here. Now, benefits of integrated risk framework are, what are the benefits of integrated risk framework? Basically, integrated risk framework helps the institution that they can align their capital and whatever the reserves they have with the actual risks they are facing, which helps in ensuring that they are adequately capitalized to cover potential losses. So the benefits of an integrated risk framework are here. I think according to me, the answer will be none of them. What according to you? None of them or all of them? I think benefits of integrated risk framework. It is aligning their capital, so is marking risk transfer decisions. Yeah. Yeah. It relates the capital and reserves more effectively for their actual level of risk exposure, to also evaluate the pricing decisions and the product profitability, and also is making risk transfer decisions. So we can mark option 1 is correct here, all of them. Okay. Now, rewards of proper management of operational risk are, rewards of proper management of operational risk are, see, proper management rewards in operational risk are, basically we can say that all of them, because lesser risk capital, cost risk reduction in operations, and also competitive edge. So we can mark here option A is correct, all of them. Okay. Now, what is the beta factor for corporate finance under standardized approach? What is the beta factor for corporate finance under standardized approach? I think beta factor for corporate finance under standardized approach is 18%. Because under the standardized approach for credit risk is in corporate finance, the beta factor is typically 18%, and this factor used in the calculation for the capital requirements for the credit risk, which allows the institutions to assess the level of risk which are associated with their corporate expenses. So here the correct answer is 18% because these type of things are fixed. And we know that what is beta factor. Beta factor we can say is the context of finance. Particularly we can say that credit risk and capital adequacy, if is under the regulatory framework, refers to the risk weighting factor that helps in determining the amount of capital if a financial institution needs to hold against any potential loss for various type of exposures. Dash is the process that involves bank assessment of its operations and activities against an already listed menu of potential operational risk weakness is here. Which type of assessment is here? See, risk and control self assessment is correct here because this is the process in which the bank assessment, evaluation of bank activities, of all the operations in the bank which are against an already listed menu of potential operational risk weaknesses. So we can mark here risk and control self management. This is basically the process which is used by the banks and the financial institution to evaluate their operations and the activities, and it involves basically identifying the risk, assessing their impact, and also evaluating the effectiveness of internal control. So here the correct answer is risk and control self management assessment. Okay. If we talk about key risk indicators, basically this is used for the early warning. If any early warning of increasing risk exposures in various areas of the system. Okay. And external and internal control factors, we know what are internal control factors. If anything in the organization we can control, that is internal control factor. If outside the organization or outside the institution, that is external control factors. Okay. So next our unit is liquidity risk management. After this we have only one unit left. So yeah, let's do this unit, liquidity risk management. In this, overall responsibility for management of liquidity risk is always lied with the board of directors. So answer is here board of directors. Then what is the role of deciding the transferring pricing policy of a bank and making liquidity cost and benefits an integral part of bank's strategic planning? Always, whatever the transferring price policies related things of a bank is done by the asset management committee, that is in short ALCO. Okay, asset liability management committee. It is responsible for overseeing the bank's balance sheet, including the performance, including the management of various type of risk, whatever the interest rate, credit risk, market risk, every risk, and overall financial performance. Option C is correct here. Okay. Temporary assets do not include here intangible assets. Temporary assets do not include intangible assets. In the risk management framework of the bank, which risk is called as fatal risk? Which risk is called as fatal risk? See, fatal risk is a type of risk that can have some consequences for an organization, particularly in the context of financial institutions. They may face some type of consequences. It is often that risk that can lead to the financial loss, legal penalties, and also some reputational damage or even the insolvency. So in the risk management framework of the banks, which risk is called as fatal risk? Liquidity risks are called fatal risk. Okay. So let's see our next unit. In this unit, true and false are there. So first is, banks are not required to strive to achieve a higher ratio than the minimum prescribed above as an effort towards better liquidity risk management. See, if we talk about LCR, liquidity coverage ratio, basically is indeed defined as the ratio in which high quality liquid assets to the next cash flows that a bank expects to incur over 30 days. We are saying banks are not required to achieve any type of higher ratio than a maximum prescribed above as an effort, because this statement is false. This statement is completely false. Okay. Now, Basel III framework prescribes two monitoring tools, metrics for better monitoring a bank liquidity position in addition to the liquidity standards. See, this statement, basically Basel III framework prescribes two additional metrics, tools for banks to assess their liquidity position. According to me, this statement is true. According to me, this statement is true. Okay. Next is, LCR needs to be monitored only in home currency. See, LCR needs to be monitored not only in the home currency but also across all the currencies in which a bank operates. So this statement is completely false. Now, retail deposit include all the demands and the term deposits, which including bulk deposit and excluding foreign currency deposits placed with a bank by a natural person. Retail deposits typically refers to those deposits which are made by the individual customers in banks, which can include both type of deposits. So in this we can say that this statement is also incorrect. Okay. And one more question for today is left, that is, total stock of HQLA of a bank is rupees 60 crore. In this, how much maximum the bank can have in the form of level 2B assets? Last question for the today. Then we completed our module B. Total stock. See, whatever the level 1 assets here, these can be included without any limit in the calculation of HQLA, and we know that maximum level 2B assets is equals to whatever the total HQLA is multiplied by 15%, because level 2B assets are up to 15% of the total HQLA. So here 60 crores are there. Okay, 60 crores when multiplied by, here 15% can be written as 0.15. So it will be equal to, here after calculation, I think 9 crores. I am correct or wrong that this calculation's answers is 9,000 crores? Tell me fast that the answer is 9,000 crores. I am correct or not? 60 crore. Yeah, 9,000 crores. So option C is correct. So thank you so much for watching this long session. It is almost 2 hours. I hope you all are enjoyed, and also so many concepts are covered. A quick revision will be done through this. So I hope you liked. If you liked this session, kindly do comments. Yes, Jiva ma'am, we will share some more MCQs in the upcoming lectures. You will notified about this. Don't worry, we will cover everything. I hope you liked. If you liked, so like this video, subscribe to this channel, and also comment in the video. And we will meet in our next lecture with some more questions and some more topics. Till then, take care everyone. Bye bye everyone, and have a good day.